If your application is growing, your AWS compute bill is likely climbing right alongside it. The goal is simple: cut those infrastructure costs down to size without accidentally breaking the systems you've already built. To pull that off, Amazon gives you a primary financial tool, the AWS Savings Plan. Looking at this matrix, we have to clear up some persistent technical myths. A savings plan is not a prepaid block of AWS credit. It does not reserve physical server capacity for you, and it is not tied to a fixed machine. Instead, it is a strict billing discount agreement. You promise AWS that you will spend a specific dollar amount on compute power every single hour. In return for that guaranteed spend, AWS drops the price of the compute resources you actually use. Treating this strictly financial agreement like a technical configuration creates a serious dilemma. Engineering teams end up paralyzed, afraid that locking into a multi-year contract will accidentally cost them more money if their workload changes or migrates to a different service. To evaluate that risk, you need to understand the scope. A savings plan does not apply to your entire AWS bill. It is highly specific to your compute usage. It covers your EC2 instances, ECS Fargate tasks, Lambda functions, and EKS worker nodes running on EC2. It completely excludes storage and databases. Your S3 buckets, EBS volumes, and RDS databases will see zero impact from this agreement. If you calculate your compute usage correctly, you can safely shave thousands of dollars off your monthly operating expenses. If you calculate it incorrectly, you create an irreversible daily financial bleed that you cannot cancel. Successfully navigating these stakes requires performing a rigorous hourly ROI analysis on your infrastructure spend, rather than treating the purchase as a simple discount applied at checkout. The foundational rule of this system is time. AWS checks your eligible compute usage strictly on an hour-by-hour basis. This chart shows the perfect scenario. The dotted line represents your hourly financial commitment. Let's say it's $1 per hour. The bar is your actual compute usage. When your usage perfectly meets that $1 mark, the entire hour is heavily discounted. You get maximum value. If your traffic spikes and your usage pushes above your commitment line, that excess compute is simply charged at the standard undiscounted on-demand rate. If your usage drops below the dotted line, your bill does not shrink to match it. You still pay that full $1 commitment, leaving the gap between your actual usage and your promise as pure wasted spend. Those unused commitment dollars do not roll over to the next hour. They vanish. AWS runs this exact evaluation 24 hours a day, 365 days a year, for the entire duration of your 1- or 3-year term. Because the check is unrelenting, a savings plan will severely punish a fluctuating architecture if you set that commitment level even a fraction too high. Most modern production environments are not flat. They auto-scale up and down to match user traffic. During daytime business hours, your compute clusters expand to handle peak requests, driving your hourly costs up. Late at night, those identical clusters scale down to handle a fraction of the load, dropping your compute costs into a deep valley. When engineering teams look at their high daytime usage and purchase a savings plan to capture the biggest possible discount for those peaks, they draw their commitment line high, cutting through the busiest parts of the day. When the sun goes down and traffic scales back, actual usage comes crashing down into the valley. But that high commitment line remains locked in place. Every single hour the business is asleep, it bleeds money. If you overcommit and generate just $3 of waste per hour during a 12-hour low period, you lose over $2,000 in pure cash every single month. Attempting to maximize your discount during peak business hours introduces the severe risk of catastrophic wasted spend while the business is asleep. Once you understand the hourly risk, you have to choose between two distinct types of plans to lock in your purchase. The EC2 Instant Savings Plan offers the highest raw discount percentage, but it rigidly locks you into a specific AWS region and a specific server family. The alternative is the Compute Savings Plan. As you can see on the right, it trades a slightly lower discount for total mobility. It automatically applies across different instance types, different regions, and different compute services entirely. If you are a dynamic engineering team, meaning you actively autoscale, or you plan to migrate workloads to ECS, EKS, or Fargate over the next year, you need the Compute Savings Plan. The EC2 Instance Plan is built for static enterprise baselines. You only choose it if you are running legacy monolithic servers 24/7 with absolutely zero intention of modernizing them. For modern cloud architectures, the freedom to change your tech stack without breaking your financial agreement is more valuable than chasing a slightly higher discount. The golden rule of AWS Savings Plans is simple. Calculate your absolute lowest 24/7 stable compute baseline and commit exclusively to that number. Open AWS Cost Explorer and analyze your historical compute spend over the last 3 to 6 months. You must manually filter out any unstable workloads. Strip out the costs of temporary batch jobs, disaster recovery tests, and development environments that your team shuts down over the weekend. Look closely at this graph again. Once you isolate your permanent production workloads, you identify the lowest point of your nighttime valley. That floor is your mathematically safe commitment target. By targeting the valley, you intentionally leave your peak daytime spikes on standard on-demand pricing. That is the precise strategic maneuver required to eliminate the risk of wasted spend entirely. With your stable baseline calculated, the final step is deciding exactly how much of that baseline to cover in your initial purchase. Rather than aiming for 100% coverage immediately, execute a conservative rollout. Target 50 to 70% of your minimum stable baseline. Select a 1-year term rather than 3 years. This ensures your financial commitments don't outlive your architectural decisions as the business evolves. Set a monthly review cadence. You only increase your dollar commitment after a new, higher stable baseline trend is definitively proven in Cost Explorer. Treat the savings plan as a strict hourly minimum spend. By committing only to the compute power you guarantee you will use in your quietest hour, you protect your infrastructure from daily waste and guarantee a positive return on your